Hello and welcome to Livewire's listed series for 2024. My name is Chris Conway. Today I'm sitting down with the Chief Investment Officer of Munro Partners, Nick Griffin, to talk about the Munro Global Growth Fund, stock code MAET, and the Munro Concentrated Global Growth Fund, MCGG. Nick, thanks for joining Livewire for our 2024 listed series. We know that Munro is all about growth, but it can come in many different forms. How do you define it, and why do you choose to look at the world this way?
Growth is all about earnings growth. Companies that can grow their earnings sustainably are the ones that we're most interested in. And there we're talking about, EPS or cash flow growth above 10% and revenue growth of more than double GDP. That's what we're looking for growth. We're looking for companies that can do that. And what you'll find is for a company to grow its revenue at more than double GDP or earnings double digit sustainably for a long period of time, they've normally got to be doing something pretty special. And so the way we think about it is, don't think about growth in terms of macroeconomic growth, think about structural growth. What are the structural drivers that are going to drive a company to be able to achieve that? And there you're looking at things like changes in technology, changes in consumer preferences, changes in medical, how we treat medical problems, etc. Those are the big structural growth drivers. Those structural drivers will give you that structural earnings growth, and that's the growth we're looking for. The last thing we just say about this is that it's important for everyone who's looking at equity markets to realise that equities are not like other asset classes. It's a game of very few winners and lots of losers. Most companies are just leveraged to that macroeconomic growth. We're trying to find that structural growth, and what we do is just look around these different areas of interest, because that's going to create the few winners, that's going to give you double-digit returns, and that's going to drive the performance of your products.
Nick, you said not to worry too much about the macro, but I do have to ask you the question about growth as a factor. It had a dominant period for 10 years, a little bit sort of in between over the last couple of years as the world's trying to figure out which way to go, and it's come roaring back in the last 3 to 6 months. How do you see growth performing now and into, let's say, the next 2 years?
Yeah, so growth's had a strong period because we've basically been through a strong period of innovation. The S&P 500 is a good example of this, where the earnings growth of the S&P 500 has got better and better every year for the last decade. And that's really driven by the technological changes that we've seen in the world in the last decade or two. Obviously, that wasn't the case in the last 2 years, and because of what was also driving it was interest rates getting lower and lower and lower. And so you were getting strong earnings growth, but you're also getting a little bit of multiple growth. That reversed dramatically in 22 because interest rates went from 0 to 5%, and they did it really, really quickly. So the earnings growth of the companies wasn't fast enough to outrun what the multiple was decompressing because of the 0 to 5%. That was a good wake-up call for growth equity investings, and it arguably growth had got ahead of itself coming into 2022 as well. What we see now is actually a really good setup because rates have normalised from 0 to 5. Central banks sit in a very strong position now to basically manage the economy because they've gone from 0 to 5 without seemingly collapsing the economy. So they now have buffers to manage the economic cycle now for the next decade. And all you've seen in the last 12 months is as soon as rates stopped going up, stocks just went back to following their earnings, which is what they do best, which is what we're trying to find. And so we think the setup for growth investing is good because it's unlikely that rates go from 5 to 10 from here. They probably go from 5 to 4. And the earnings growth of these companies has continued all the way throughout this period, and if anything is accelerating. And so companies are going back to following their earnings growth, rates are sort of out of the picture. And so from our point of view, that makes it a good time to be looking at growth investing today.
Nick, let's talk about the major themes you're pursuing in the funds that you manage. Where are the multi-decade growth opportunities that you guys are getting after?
Yeah, so we've been doing this a long time, right? And it's nearly 25 years for me, and as fund managers, more than 15 years. It's important to remember there's always a big structural change occurring. I was around when the smartphone came along, and Apple launched their first smartphone, and people were like, why would I want the internet on my telephone? I was around from the 4G to 5G shift. I was around for the shale gas revolution. All of these, there's always something coming along that will ultimately drive these next structural changes to create these next structural winners. Right now, the big one is clearly AI. It's artificial intelligence. We think this is akin to the mobile cycle. And to maybe put another bit of context around this, I've been doing this 25 years. This is the third time this has happened in my lifetime. So I was around for the internet boom, and I was 25 years old. I had no idea what was going on. I was around for the mobile boom, and ultimately, we found Apple, made a lot of money out of it, and then obviously worked out what mobile technology would do for companies like Google, Facebook, Netflix, all these things that basically created those huge winners. And now we're right at the start of the AI boom. It's going to change the way we work. It's going to change the way we do everything. And our job right now is to position the fund for the big structural winners from AI. And that's basically the big one that we're focused on today.
Nick, let's focus in on AI a little bit more. There's so many opportunities within the stack. We've got platforms, semis, apps, software, design. Where do you think the juice is and where are you investing within the stack?
Yeah, so right now, like I said, we're right at the start. We don't know what the big applications that are going to come from it are. We've got some idea. But right now, it's time to invest in the shovels in the boom. The shovels in the boom, because what we know is that everybody in the world is leaning into this technology. Everyone else is either trying to design an AI product that's going to win, or they're trying to stop themselves being disrupted by an AI product that's going to disrupt their business. And so by definition, everybody has to invest today, period. They don't have a choice. And as they invest, we think they'll invest heavily in bringing their data onto the cloud. And so that data, that massively advantages the cloud service providers, of which there are only 3 in the world, being Amazon, Microsoft, and Google. The cloud service providers are where you're going to host all your data to try and manipulate that data to try and get the AI outcomes. The second big shovel in this boom is obviously the semiconductors. So the cloud service providers, to gear up to host all of these new applications, is investing heavily in semiconductors. And that's where you're investing in Nvidia, obviously, and Nvidia's supply chain. So that's TSMC and Foundry, that's ASML in equipment providers. And then you can really go, if you want, go even further down into how they package these products, the advanced packaging. The good example that we talk about here is if you go back to that mobile example I gave you, the smartest thing you could have done in 2008 was get the Apple iPhone and smash it apart and open it up and just find every single piece in it that was going to do well. We've done that with the Nvidia H100, and that's how we position the fund. So semis first with Nvidia and the supply chain, the pieces it created. Cloud second, because they're basically where you're going to host all this stuff. And then the next phase and final phase that we're going to have fun with over the next 2 or 3 years is what are going to be the killer apps that come out of this. And there I think you're really focused around software companies. Software companies control all your data at the moment, and they found a whole new way of selling it back to you. And so just think about accounting software, think about Adobe, think about Microsoft Copilot. You're using Microsoft in all your products, and then you're going to pay to get the Copilot because it's going to make you using Microsoft easier. And so the simple way of thinking about this is every $1 that Microsoft spends on Nvidia chips, they're probably going to get $5 back from their customers through applications of AI. And this is just the wonderful magic pudding that technology creates sometimes, and that's what the cycle we're in right now.
Nick, let's zoom in again. Let's talk Nvidia. I know it's a key holding for you. You and I have spoken about it in the past. You were very humble last time we spoke and said that you'd been holding it way ahead of the curve. It's done incredibly well for you now. I was reading recently after the recent results that it would have to grow at 20% earnings growth for the next 20 years to justify the share price today. A couple of companies have done that in the past. Apple did it, Microsoft did it, but they did it when they were much smaller market cap. What would you say to that as a keen investor in Nvidia?
We've owned Nvidia for more than 5 years, and I definitely looked at it in the 5 years before that as well. Nvidia's been around since the late 90s, mid 90s, and it's been growing comfortably 20% every year, compound on average since then. As you sit here today, Nvidia, it's important to stress that Nvidia is not an expensive stock today, okay? It trades on 28 times consensus earnings next year, and we'd argue it's 25 times what the real earnings are going to be next year. The bit that everyone's struggling to get their head around is the earnings have gone up 5x in the last 2 years. This company was earning $5 in EPS in 2020, and it's going to earn $25 of EPS in 2024. Sorry, 2021 to 2024. So the earnings have gone up dramatically. And what we're all trying to work out is this pull forward because everyone's gearing up for an AI revolution that might not happen, or is this just the start of what's going to happen? I can tell you this, our model for Nvidia, even before generative AI, said that their earnings would get to roughly $30 in EPS by sort of 26, 27. They're now going to do that probably next year in 2025. And our question is do we then recalibrate that model to the earnings going from $30 to say $50 or $60? And we still think it can. And so if the earnings go from $30 to $60 from here and the stock still trades at 30 times earnings, then in theory it's still going to double from here. That's the sort of simple maths we're doing here. But I want to push back on the valuation stuff. Nvidia is not an expensive stock. It's just a stock that's grown at an unprecedented rate, at an unprecedented scale, incredibly quickly. And I can see why people are not sure about what happens in the next few years. We're not sure what happens in the next few years either. But I think in reality, the next 3 to 5 years, AI is going to be big. There might be a bit of pull forward, The $30 is probably going to $50 or $60. The question is it going to be a straight line from here? Is it going to be a down then up, or is it going to be an up then down? And that's the bit that I think people are struggling with.
Maybe it's the people that don't hold it that are struggling more, Nick.
Well, that's usually the case as well, honestly. I mean, look, this isn't the first time this has happened to us. We've owned Amazon for a decade. Prior to that, we owned Facebook for a long time. It's generally the most hated stocks that do well, or the ones that people don't understand. And then later people come around and say, oh, I now understand Google. Google IPO'd at 70 times earnings and nobody bought it. Right. And now every fund manager in the world owns Google and it trades at 20 times earnings. And the joke I always make is when was Google more expensive, at 70 times or 20 times? And the answer was, it was more expensive at 20 times. It was cheapest at 70 times earnings when it IPO'd. You just had to do the work. Yeah. We've done the work on Nvidia. Obviously it's playing out now. It could be ahead of itself, but our work says there's still more to go here.
You talked a little bit about the math there and obviously what you're paying attention to and how you're valuing the stock. How does that feed into a potential exit strategy? Is it just basically if the numbers no longer add up the way you want them to, that's your signal or your early signal to maybe take some profit or consider getting out?
Yeah, exactly that. So we're setting effectively 5-year price targets and the company needs to be able to double within the next 5 years. If it can't double within the next 5 years, then that's a red flag for us. We're monitoring those on a 12-month basis, but we are effectively setting those price targets. Your best ideas always go further than you think, significantly further than you think. Again, I'd use the example that we had previously with Apple. I was there for the Apple cycle. We made a lot of money. Apple, it's our third best investment of all time. We sold it basically back in 2017, 2018, and it's doubled again since then. And so sometimes you usually get off always too early on your best ideas. But yes, from our point of view, the mass has to add up. The mass on Nvidia still adds up. If it got to its price target, we would definitely trim it. If it got well through its price target, we may sell it altogether. But that's essentially what we're doing. We're trying to build the bottom-up mass to prove probabilistically that these companies can still double within the next 5 years. And Nvidia to us still can.
Nick, in your last monthly, IT was your biggest weighting at 46%. Consumer discretionary, next biggest weighting at 14%. Maybe a bit of a surprise considering where interest rates are at and the pressure we've seen on consumers. Why are you liking that thematic so much and what's one of your most important holdings in the space?
Remember at the start we talked about structural growth. We're trying to find structural growth companies that can grow structurally through the cycle. Changing consumer preferences is a big one for finding these structural growth companies. And then you're also looking for these very clever companies that have positioned themselves quite well to grow quite strongly through this period. We have a number of companies invest in this area that are doing well even in a difficult consumer environment. I'm going to give you 2 examples. The first I'd give you is Lululemon, which we've owned for a while. Lululemon is a dominant, obviously, provider of activewear. Most people in Australia are familiar with it. Most people in America are familiar with it, but you'd be surprised to understand that they're actually not that big outside of these 2 countries. They're very underrepresented in China. They're very underrepresented in Europe. They're very underrepresented in menswear. They're very underrepresented in shoes. And so we still see a long runway of growth for Lululemon to continue to execute on an algorithm that's worked well for them in different countries. And so that ultimately drives strong double-digit earnings growth over the next 5 years. And you're paying just under 30 times for that. As long as it holds the 30 times, the double-digit EPS growth is eventually going to get you a double over the next 5 years. Second example I'd give you would be Chipotle Mexican Grill in the US. This is essentially what Guzman Gomez is effectively modeled on here in Australia. There, it's again the same argument. You've got a proven algorithm that works, okay? You've got a proven algorithm where people like your product and you've just got white space to roll stores into. And so in the US, Chipotle has 3,500 stores. We think they can easily get to 7,000. If you think about it, McDonald's has got more than 10,000. You can clearly see this getting to roughly the same size. And so as they roll out the stores, that equals strong double-digit earnings growth. The comp sales go on top of that. Again, the multiple's not too high, and so you can mathematically get to a double, provided they continue to execute on that, and provided the competition doesn't come along and eat their lunch, pardon the pun.
Nick, another area of interest in the portfolio at the moment, digital payments. I think it's about 9.6% of the portfolio when I checked. What's the thesis there? Is it connected to AI or is it independent of that? And what's maybe a stock that you like in that space?
Yeah, okay, so this is as simple as, okay, so here we go. This is where Visa and MasterCard sit, which we have owned for a decade, owned since day one in the Munro Global Growth Funds and have not sold in 7 years. So coming up to 8 years. This is, again, about finding that structural earnings growth and running it for long periods of time. Okay, so this is really simple. Like Visa and MasterCard are benefiting from the shift from physical to digital cash. 10 years ago, we all walked around with cash in our wallet. Now we don't. And that's slowly permeating its way across the world. Australia is pretty much 100% digital now. But for people who are listening, we're the second most developed country in the world, behind Sweden. The rest of the world is still catching up to this, and this is obviously a huge tailwind for Visa and MasterCard. It is one that will run out eventually, but those stocks have been very good to us for a very long period of time, so they still make up that period because we still have not got off that bus. We still think the shift from cash to card has further to run. The only other thing we'd flag is this is also where we're adding newer things like fintechs. The big fintech we like there is Wise. It's the company we pitched at Son last year. These are the disruptors in the space, and there are lots of disruptors. Clearly the space will eventually get more disrupted over time. And of that group, we like Wise the most because we think they're the ones that are just going for the lowest cost solution no matter what. And that's ultimately how you win as a disruptor.
Nick, in any portfolio of bets, there's always the mainstream stocks that you were just talking about, the ones that you probably should keep holding even once they hit your price targets. But there's also some smaller stocks, some smaller opportunities, maybe less portfolio weight that could have huge upside, but they're not mainstream. What's one of the ones in the portfolio that you're looking at the moment that's incredibly exciting and could be a big payoff?
Okay, so I'm going to give you two areas. Okay, so the first is climate. A lot of people we're on the decarbonisation train and then they're off the decarbonisation train. The reality is the world's still trying to decarbonise at an incredibly rapid rate. And what's going on with AI is only going to put more pressure on that because of the amount of power that it's going to consume in data centres, etc. So within the fund, we have a couple of really good ideas around decarbonisation, mainly around energy efficiency, how you cool data centres, how you fix data centres, and then also some ideas around solar. The great thing about the decarbonisation ideas is they're all quite small. They're sort of sub 10 billion market cap, and there's a couple of good ideas there. The one I'd point to that we like a lot at the moment is Nextracker, which is a company that specialises in solar trackers. The second big area, again, that I'd flag is what I was talking earlier about semiconductors. AI is effectively redesigning the way you make semiconductors. You used to put sort of memory, CPUs and GPUs all in different parts of your computer. If you ripped it open, you would find them in different parts of your PC. They're now all coming together on the one chip. This is changing the way we design semiconductors for the first time since the semiconductor was first designed. It's not about shrink, it's about packaging. And so we've invested in a number of companies, again below 10 billion market cap, that are basically specialised in the technology as to how you what's called advanced packaging or heterogeneous integration, how you integrate these different parts of the computer into the one chip. It's a very specialised technology, it's a very specialised area, one we did a lot of work on last year, and these companies are really 5-10 times your money opportunities as the world shifts to AI chips and away from regular CPU chips that we built previously.
Nick, we're here for LiveWire's listed series for 2024. There are two ways that investors can get involved with Munro via the ASX. One is the Munro Global Growth Fund, which is MAET, and the other one is the Concentrated Fund, which is MCGG. Can you just explain the difference between the two for potential investors?
Yeah, so MAET is our absolute return product. So this is the fund where we invest in everything we just talked about, but we offer some downside protection. So we offer the ability to go to cash. We offer the ability to, short sell things like futures or buy put options on the market. Put options and things like that are very useful when something hits you from left field, like COVID, or like interest rates going from 0 to 5%. That product is really designed to look at all our best ideas, but sort of smooth the ride for clients. You own it, and for a slightly higher fee, you outsource some of the asset allocation decisions to us. And so that's our absolute return product. That's our all-weather product. The Munro Concentrated Global Growth Fund, or MCGG, is our long-only product. So this is the product where it's all the same ideas, but it's just fully invested all the time, and you need to manage that within a diversified portfolio, if that makes sense. And so one's slightly higher risk, higher return, and one's slightly lower risk and slightly lower return, but both of them are investing in the same ideas. And so it's really what's the volatility path that the investor wants to go on. And from our point of view, we're ambivalent. We like these ideas and we think we're going to work over long periods of time. We just recognise that every client or every investor is different and they have a different appetite for risk, and so we offer the two choices.
Nick, thanks for chatting with LiveWire.
Thanks very much for having me.
If you enjoyed that interview as much as I did, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.